The first thing I want you to understand is that when a financial order begins to change, it rarely announces itself with one dramatic event. It does not usually arrive as a single headline. It arrives as a pattern. One reserve currency weakens quietly. One major country changes the way it stores value. One group of nations starts settling trade outside the old system. One central bank buys more gold. One payment network starts taking a little volume away from the system everyone thought was permanent. Then one day, people look around and say, how did the world change so much without me noticing? That is where I believe many investors are right now. The United States dollar is still the most important currency in the world. The United States is still the deepest capital market in the world. It still has the most important military, the most liquid markets, and many of the most innovative companies. I do not believe the dollar is disappearing tomorrow, and I do not believe intelligent investors should panic. But I also do not believe intelligent investors should ignore the machine that is already moving. The dollar has been having one of its weakest periods in decades. Oil prices have been rising, which creates inflation pressure. Stagflation risk is back in the conversation. And behind those immediate headlines, something larger is happening. The global balance of power, trade, money, and investment opportunity is starting to shift. Most people are trained to think about investing as though the next decade will look like the last decade. They look at the largest American technology companies. They look at the same portfolio that worked very well for them in the past, and they assume the same structure will continue forever. That is a dangerous assumption. One of the principles I have learned from studying markets and empires is that nothing lasts forever in the same form. Systems rise, systems mature, systems become overextended, and then systems adjust. Sometimes the adjustment is violent, sometimes it is slow, but the adjustment always comes. The important question is not whether the United States is finished. That is the wrong question. The important question is whether the world is becoming less dependent on one country, one currency, and one financial system than it used to be. And the answer to that question is yes, to understand why this matters for your money. You have to go back to the structure that was built after World War II. After the war, the United States came out with an extraordinary position. It had the dominant economy, it had the strongest military, it had the deepest financial markets, and critically, the dollar became the world's reserve currency. That sounds technical, but it is not hard to understand. It meant that other countries needed dollars. They needed dollars to buy oil. They needed dollars to settle international debts. They needed dollars to conduct global trade. They needed dollars to store reserves. And because the rest of the world needed dollars, the United States received what economists call an exorbitant privilege. That privilege meant the United States could borrow more cheaply than other countries. It could run deficits for longer, it could print more money, it could sell debt to a world that still wanted to hold dollars. This did not mean there were no consequences. There are always consequences. But it meant the consequences came slower than they would for almost any other nation. That is a very powerful position. But it is also a position that depends on trust. The rest of the world has to trust the dollar. It has to trust American markets. It has to trust that the dollar system is still safer and more useful than any alternative. And when trust begins to weaken, the system does not collapse all at once. It gets diluted. That is the word I would use. Not collapse, dilution. The dollar is not being replaced overnight. It is being used a little less. It is being held a little less. It is being questioned a little more, and other countries are building options. So they are not trapped inside one system. This is how big shifts usually begin. They begin at the margin, a little less dependence, a little more diversification, a little more gold, a little more trade in local currencies, a little more experimentation with payment systems that do not go through the old dollar. Based infrastructure, each small move may look unimportant by itself, but when you put them together, you begin to see the pattern. In 2016, the dollar made up about 65% of global foreign exchange reserves. By 2024, that number had fallen to about 59%. By 2025, it had moved down toward roughly 57%. That is not the end of the dollar, but it is a signal. A reserve currency does not usually lose its position in one clean break. It loses it gradually as countries diversify away from it because they no longer want all of their risk concentrated in one place. This is especially important after what happened when the United States and its allies froze Russian reserves after the invasion of Ukraine. Whether one agrees or disagrees with that decision politically is not the point I want to make here. The investment point is this: every country that is not fully aligned with the United States looked at that moment and learned a lesson. They learned that reserves are not just reserves, they are also political assets. If your reserves are held in a system controlled by another power, then in an extreme situation, those reserves can become vulnerable. That realization changed behavior. Countries began asking a simple question: What if this happens to us? That question is powerful because it changes incentives. It makes countries diversify before a crisis, not after one. It makes them buy gold. It makes them settle more trade in their own currencies. It makes them build payment systems that can move money without depending entirely on the dollar or the Western controlled infrastructure, and that is what we are seeing. China has reduced its reliance on U.S. treasuries in 2010. China held roughly 40% of its reserves in U.S. treasuries. By 2025, that share had been cut roughly in half. That does not mean China has sold every dollar asset it owns. It means China is reducing concentration risk. This is what large players do when they see a system becoming more uncertain. They do not scream. They do not panic. They rebalance. And when a large nation rebalances, it changes the world slowly. China has also been developing its cross-border interbank payment system, which facilitates transactions in yuan. Other countries are using bilateral trade settlements, meaning they settle trade directly in their own currencies instead of routing everything through the dollar. BRICS nations have been discussing and developing payment systems that allow more trade to happen in local currencies. There are experiments with blockchain-based settlement frameworks among central banks. There are proposals for digital settlement currencies backed partly by gold and partly by baskets of BRICS currencies. Some of these systems are early, some may not work, some may take years, some may be more symbolic than practical right now. But that is not the key point. The key point is that the purpose of these systems is not always to replace the dollar completely. It is enough to reduce dependence on the dollar. That is what most investors miss. You do not need another currency to become the new dollar tomorrow in order for the old dollar system to weaken. You only need enough countries to decide that they want alternatives. When enough countries want alternatives, capital starts moving differently, trade starts settling differently, central banks hold reserves differently, and investors who keep all of their money in the old assumption may wake up one day and realize the world has changed around them. This is where the issue becomes personal. It is very easy to talk about reserve currencies, central banks, gold, China, BRICS, SWIFT payment systems, and world order as though these are remote subjects that only matter to governments and institutions. But they also matter to your portfolio. If the dollar weakens over time, it changes returns. If emerging markets grow as a larger share of the world economy, it changes where opportunities are. If U.S. valuations remain stretched while international valuations are lower, it changes expected future returns. If the top American companies become a larger and larger part of the index, it changes the concentration risk that many investors do not realize they are carrying. This is not about fear, it is about understanding the system you are in. The average American investor often has the majority of their money in U.S. assets. In many cases, that made sense. The United States was the fastest growing and most profitable large economy for a very long time. It had exceptional companies, it had innovation. It had liquidity, it had rule of law, it had the dollar system supporting it, but the question is not whether that was true in the past. The question is whether the next decade will reward the exact same concentration. The major institutions have been adjusting their expectations. Vanguard has projected lower annual returns for U.S. stocks over the next decade than many investors have become used to, while expecting somewhat better returns from international markets. J.P. Morgan has been more constructive on emerging markets. Fidelity has also pointed to stronger long-term return potential outside the United States. These forecasts can be wrong. Forecasts are always uncertain, but when different major institutions independently come to similar conclusions, I pay attention. I do not blindly accept it. I do not treat it as destiny. But I ask what the underlying logic is. The underlying logic is not difficult. U.S. stocks have had a very strong run. Valuations are high. The top companies dominate a very large portion of the index. The S&P 500 is more concentrated than most people understand. The top 10 companies represent a very large share of the whole index, which means many investors who think they own broad diversification are actually heavily exposed to a small group of very large companies. At the same time, many international and emerging markets begin from lower valuations. They may have more room to grow, they may benefit if the dollar weakens, and if emerging economies like India continue growing in population, productivity, and technological sophistication, they can become a much larger part of global market returns. This does not mean you sell America. That would be another kind of mistake. It means you stop thinking that one country must always be the only answer. India is a very important example. China gets a lot of attention because it has already become a giant economic force. But India's population is younger, its population is still growing, and its technological adoption is significant. Forecasts suggest India can become a much larger economy in the next decade and beyond. If the world becomes more multipolar, meaning power, growth, and capital are spread across more than one center, investors should think in a multipolar way too. That does not mean chasing every market. It means recognizing that diversification is not just a slogan. It is a defense against being wrong about the future. When I think about portfolio construction, I begin with a simple principle. Do not put yourself in a position where you need one outcome to happen. If you need the dollar to stay dominant forever, you are fragile. If you need us mega-cap stocks to outperform forever, you are fragile. If you need inflation to stay low forever, you are fragile. If you need the world to remain politically stable forever, you are fragile. Good investing is not about predicting one future with total confidence. It is about building a portfolio that can survive and compound across multiple plausible futures. That is the point of diversification. Most people think diversification means giving up upside. I think of diversification differently. It is a way of staying in the game when your base case is wrong. And in markets, being wrong is not unusual. Being unprepared for being wrong is what destroys people. So when I look at the changing world order, I do not say, the dollar is dead. That is too simplistic. I say, the dollar's dominance is being diluted, and that has implications. The next question is what to do. The first thing I would do is avoid going all in on the United States. This does not mean abandoning the United States. It means recognizing concentration risk. The United States still has extraordinary advantages. It still leads in many of the most important technologies, including artificial intelligence, semiconductors, and biotechnology. It still has the deepest capital markets. It still has the most liquid treasury market. It still has scale, institutions, innovation, and military power. But being strong is not the same as being the only place where investors should have exposure. The U.S. can remain strong while other markets outperform from lower starting valuations. That is a very important distinction. A country does not have to collapse for diversification to matter. It only has to underperform expectations. If U.S. returns are lower over the next decade than investors have become used to, and international or emerging markets perform better, a portfolio concentrated only in U.S. assets may not fail, but it may miss a significant part of global growth. That is why I believe having some international exposure is rational. For many investors, a simple international index fund can do the job. It does not need to be complicated. Most investors do not need to pick individual companies in countries they do not understand. They need broad exposure to the possibility that global growth will not be dominated by one market forever. The second thing I would think about is emerging markets. Emerging markets are not easy. They are volatile. They have political risk. They have currency risk. They can disappoint for long periods. They are not magic. But they also represent where much of the world's population growth, consumption growth, and productivity catch-up may happen. If emerging markets grow from 27% of global stock market value toward a much larger share over time, and if India's share expands significantly, then investors who have no exposure to that transition may be ignoring one of the biggest structural changes of the coming decades. Again, I would not bet everything on this. I do not like all-in thinking, but I would not ignore it. The third area is precious metals, particularly gold. For many years, I have thought about gold as a hedge rather than a productive asset. Gold does not generate cash flow. It does not innovate. It does not hire engineers. It does not compound earnings the way a great business can. But gold has one important quality. Governments cannot print it. That matters more when debt levels are high, when currencies are being diluted, when geopolitical risk rises, and when central banks themselves are buying gold at a very fast pace. When central banks buy gold, they are not trying to get rich in the ordinary investment sense. They are trying to reduce dependence on currencies controlled by other governments. They are trying to hold a neutral reserve asset that tells you something about the system. I do not believe gold should be the center of most portfolios, but I do believe it can have a role as a diversifier in an environment where reserve currency risk and debt cycle risk are becoming more important. The fourth area is commodities. Commodities are connected to the real economy. Oil, copper, metals, food, and the materials the world needs to build. Transport, electrify, and feed itself become more important when emerging markets grow and when inflation risk rises. Commodities can be difficult because they are cyclical. They can rise dramatically and fall dramatically. They are not always good long-term compounders by themselves, but as an inflation hedge and as insurance against supply shocks, they can play a role. If the world order changes and more growth comes from emerging markets, demand for commodities may be structurally stronger than many people expect. If the dollar weakens, Commodity prices in dollar terms can rise. If geopolitical shocks disrupt supply chains, commodities can protect parts of a portfolio that ordinary equities may not. This does not mean speculating aggressively. It means understanding what different assets do in different environments. The fifth thing is to not abandon the United States. This is where people often make the mistake of going from one extreme to the other. They hear that the dollar is weakening, so they think they should sell everything American. That is not how I would think. The United States is still a major engine of innovation. It has companies that lead the world, it has deep capital markets, it has many problems, but it also has remarkable strengths. Even if future U.S. stock returns are lower than they were in the past, lower does not mean negative. Vanguard still projects positive annualized returns for U.S. stocks over the next decade. The U.S. remains essential to global investing, so the right answer is not to run away from the United States. The right answer is to build a portfolio that does not require the United States to be the only winner. This is the way I think about it. If the United States continues to dominate, I want to benefit. If the dollar gradually weakens, I want to be protected. If emerging markets outperform, I want to participate. If inflation runs higher than expected, I want hedges. If the world becomes more fragmented, I want assets that can survive that fragmentation. That is not a prediction. It is a balanced design. Most retail investors are not prepared for this because they are still anchored to what worked in the last cycle. And anchoring is one of the most dangerous human weaknesses in investing. When something works for a long time, people assume it is natural law. They think U.S. stocks must always outperform. They think the dollar must always dominate. They think the same 10 companies can keep carrying the index. They think the world order they grew up in is permanent, but history does not work that way. History is a series of cycles: debt cycles, currency cycles, empire cycles, innovation cycles, geopolitical cycles. The people who do well are not the people who believe the last environment will last forever. They are the people who see the transition early enough to adapt without panicking right now. I believe the transition is not from dollar dominance to dollar death. It is from a unipolar system to a more multipolar system. That means the United States remains powerful, but not alone. It means the dollar remains important, but less absolute. It means emerging markets become more relevant. It means gold and commodities regain importance as diversifiers. It means investors need to think globally, not because America is finished, but because the world is getting bigger. This is the deeper story behind the headlines. When people hear that China is reducing dollar exposure, they often turn it into a political argument. When people hear BRICS, they turn it into a slogan. When people hear de-dollarization, they either dismiss it completely or overreact dramatically. Both reactions miss the point. The point is not to argue, the point is to observe incentives. If you are a country that fears sanctions, you want alternatives to the dollar. If you are a central bank worried about currency debasement, you buy gold. If you are an emerging economy that wants more control over trade, you prefer local currency settlement. If you are a global investor looking at high U.S. valuations and lower international valuations, you consider rebalancing. These incentives are real. They are not likely to disappear. So the correct response is not panic, it is preparation. Preparation begins by asking what your portfolio is actually exposed to. Many people say they are diversified because they own an S&P 500 fund. But if the top companies represent a large portion of that fund, and those companies are all tied to the same market, same currency, same valuation cycle, and same investor assumptions, then that diversification may be less broad than it appears. A portfolio can look diversified on the surface and still be concentrated underneath. That is why understanding the inside of your portfolio matters. Do you own only US assets? Do you own mostly assets that benefit from a strong dollar? Do you own any assets that benefit from a weaker dollar? Do you own any exposure to international growth? Do you own any inflation hedges? Do you own any assets that could do well if commodities rise? Do you own any protection against the possibility that the next decade is not like the last one? These are not emotional questions, they are design questions. A good portfolio is a design. It has parts that respond differently to different environments. It does not rely on perfect forecasting. The great mistake is to think that because the dollar has been dominant for a long time, it must remain dominant in exactly the same way forever. The other great mistake is to think that because the dollar is weakening, it must collapse immediately. The world is more subtle than that. The dollar can weaken without collapsing. The U.S. can remain strong while losing some relative share. Emerging markets can outperform without becoming safe. Gold can be useful without being a perfect investment. Commodities can protect purchasing power without being something to hold blindly forever. The intelligent investor sees shades of probability. That is the kind of thinking I would encourage. Now look at the signs. The dollar share of reserves has been declining. China has reduced its Treasury exposure. BRICS nations are building payment alternatives. Central banks are accumulating gold. Emerging markets are projected by several major institutions to have stronger future returns than U.S. stocks. The U.S. index is highly concentrated. The dollar is still used in an enormous share of global payments and foreign exchange transactions. The U.S. still dominates innovation in critical industries. All of these things are true at the same time. That is why the answer is not extreme. The answer is balance. The best investors I have studied are not people who need to be dramatic. They are people who understand how systems work. They understand that the world changes gradually, and then suddenly they understand that preparation done early looks boring, but preparation done late looks impossible. If you wait until everyone agrees that the world order has changed, the opportunity will already be priced. If you panic before anything has actually broken, you will likely damage yourself. The middle path is to adjust intelligently before the crowd is forced to adjust. That is where opportunity lives. The opportunity is not only to protect your money. It is to position yourself for a world where the next engines of return may not be the same as the last engines of return. If emerging markets grow, you can participate. If the dollar weakens, foreign assets may translate into stronger dollar returns. If central banks keep buying gold, gold may help stabilize the portfolio. If commodities benefit from inflation and supply constraints, they can offset other risks. If the United States continues innovating, you still benefit from U.S. exposure. This is not complicated in principle. What makes it hard is psychology. People prefer what is familiar. They prefer the assets that just made them money. They prefer the country they understand. They prefer the currency they use every day. They prefer simple stories, but markets do not reward comfort forever. Markets reward understanding the relationship between price, value, liquidity, incentives, and cycles. When the cycle changes, the portfolio must be examined. The most dangerous investor is the one who says, "This has always worked, so I do not need to think." That is not investing. That is habit. And habits are often built for an old environment. I want you to think like a system designer. If the world becomes more multipolar, your portfolio should have some multipolar characteristics. If currencies are being diluted by debt and deficits, your portfolio should have some assets that are not simply claims on one currency. If growth is shifting toward younger and faster growing populations, your portfolio should have some exposure to those places. If U.S. markets remain essential, your portfolio should still own U.S. markets. If forecasts are uncertain, your portfolio should not depend on one forecast. That is the core principle. Diversification is not a lack of conviction. It is conviction in uncertainty. I do not know exactly how fast de-dollarization will move. No one does. I do not know whether China's payment systems, BRICS Pay, mBridge, or other alternatives will become major systems. Some may fail, some may remain small, some may become more important than people expect. I do not know whether the dollar reserve share will fall quickly or slowly. I do not know whether U.S. stocks will underperform for 1 decade or simply produce lower but still respectable returns. But I do know that when many important forces point in the same direction, ignoring them is unwise. Those forces are telling us that the world is becoming less centered on one system. That is enough to act thoughtfully, not dramatically. Thoughtfully, the first practical move is to look at your U.S. concentration. If your portfolio is almost entirely U.S. stocks, ask whether that is intentional or simply inherited from the last bull market. The second practical move is to consider international exposure. This can be simple. A broad international fund or emerging market allocation can provide exposure without the need to predict individual winners. The third practical move is to consider whether you have any hedge against currency dilution and debt cycle risk. For some people, that may include a small allocation to gold or precious metals. The fourth practical move is to consider commodities or commodity-linked exposure as insurance against inflation, supply shocks, and the growth of emerging markets. The fifth practical move is to keep us exposure because the United States still matters enormously and may continue to produce many of the world's best companies. What matters is the mix. A fragile portfolio depends on one future. A resilient portfolio can survive several futures. This is why I do not see the current environment as only a risk. I see it as a major opportunity when old assumptions begin to break. Money moves. When money moves, relative valuations change. When relative valuations change, investors who understand the transition can benefit. But they must avoid 2 traps. The first trap is complacency. The second trap is panic. Complacency says nothing is changing. Panic says everything is ending. Reality usually sits between those two. The dollar is still dominant, but less dominant. The United States is still powerful, but less alone. Emerging markets are risky, but increasingly important. Gold is not perfect, but useful in a world of currency uncertainty. Commodities are volatile, but relevant in a world where real assets and supply chains matter more. That is the map. When I look at the next decade, I believe the investors who do best will not necessarily be the ones who time every move perfectly. Timing is very hard, even professionals fail at it. The investors who do best will be the ones who recognize the direction of the structural shift and position themselves with patience. They will not need to know the exact day the dollar weakens. They will not need to know the exact year India becomes a larger force. They will not need to know which payment system wins. They will simply need to understand that a world with more centers of power requires a portfolio with more than one source of strength. That is the real message. If the United States remains the leading engine, a balanced investor still benefits. If global growth rotates more toward emerging markets, a balanced investor benefits. If the dollar weakens, a balanced investor has some protection. If inflation rises, a balanced investor has some hedges. If nothing dramatic happens, a balanced investor still participates. That is how I think about intelligent preparation. It does not need drama, it needs principles. The world is changing, the dollar is being diluted. The global economy is becoming broader. The old assumption that one market, one currency, and one index can carry every investor forever is becoming less reliable. That does not mean the end of America, it means the end of lazy certainty. And that can be a very good thing for the investor who is paying attention. Because when most people are still anchored to the old world, the patient investor can quietly prepare for the new one. The people who understand this do not need to predict perfectly. They need to be flexible, they need to be diversified, they need to recognize that the world is getting bigger, not smaller. And then they need to let time do the rest. That is how wealth is usually built in periods of transition. Not by panicking, not by clinging to the past, but by understanding the cycle, adjusting before the adjustment is forced, and owning a portfolio that can live through the world that is coming instead of only the world that already passed.